Hey everyone, welcome back to Corporate Decoder, the place where we dig into the documents Wall Street hopes you'll ignore. Today, we're tackling Northern Lights Variable Fund Trust's latest shareholder report. Prepare for some twists because what seems like a simple update on your investments might just have hidden details. Let's dive right in. This report covers the performance of several TOPS portfolios and we'll start with the Aggressive Growth ETF. The report spans from January 1, 2024 to December 31, 2024, so we're getting a full year's picture. One of the first things they address is cost. For every $10,000 invested in Class 1 shares, it cost about $22 or 0.21%. It's always good to know the price of admission. Next, let's see how well this Aggressive Growth ETF actually grew. Strong equity performance really helped returns in 2024. U.S. large-cap growth stocks did really well, and that benefited this fund. The managers were also happy with how their bond holdings performed, most of them beating a common benchmark. Essentially, they're saying they picked the right stuff and it paid off. Now, how has this Aggressive Growth ETF performed over the long haul? It appears it has been a bumpy ride. A $10,000 investment in December 2014 would have been worth $22,403 by the end of 2024. The S&P 500 index, though, would have grown to $34,254, so the fund actually underperformed compared to just mirroring the market. Speaking of raw numbers, the fund returned 12.21% in 2024, 8.51% over the last 5 years, and 8.40% over the last 10 years. Note that the S&P 500 index had higher returns than this one in all the periods mentioned. A key and often overlooked detail, there were no major changes to the fund during the year. This is actually good news, meaning the strategy remained consistent. TOP splits this aggressive growth fund into different classes. Let's see how they do. Class 2 is very similar to Class 1. Again, costs are highlighted with a $10,000 investment costing $49, and they highlight that the performance was similar to Class 1 at around 11.99% versus 12.21% for the year. So the performance wasn't much better, and it cost more to get in. Long-term performance for the class is also similar at $21,867 compared to the index's $34,254. But again, its costs are higher at 0.46% versus 0.21% for Class 1. The investor class was started later than the other two, in July of 2015, so it's harder to see if it's performed similarly. The expense ratio is significantly higher, at 0.71% compared to 0.21% and 0.46% for Classes 1 and 2, respectively. A $10,000 investment in July of 2015 was worth $20,378 by December 2024. The S&P 500 would have been worth $32,991, again outperforming. The investor class had an average return since its inception of 7.83%, compared to 13.47% for the S&P 500, really highlighting its underperformance. The last class of the fund, the service class, has very little data. It has only one share outstanding, with a net asset value of $20.65. It looks like they've recently started trying to add data to this class so they can report it better in the future. Let's move on to the TOPS balanced ETF portfolio. Like before, we'll focus on what's the same and what's different. It has the same $22 cost for Class 1. The balanced fund says it achieved the same excellent positioning, too, like the Aggressive Growth one. However, now the numbers are a bit different. A $10,000 investment in 2014 would only be worth $16,434 versus the index's $34,254. So a large underperformance compared to the previous one. The average return for 2024 was 7.04%, the 5-year average was 4.93%, and the 10-year average was 5.09%. All of these are again less than the S&P 500. This fund is split into around 90% exchange-traded funds, or ETFs, and around 9% collateral for securities loaned. Looking at the top 10 holdings of the fund shows that they prioritize Vanguard funds. These are the same in the previous Aggressive Growth ETF. Alright, so it's not looking amazing. Let's see if their conservative ETF portfolio fares any better. It has almost the same introduction with the same $24 costs as the first fund. The fund has very similar performance to the previous one. A $10,000 investment would be worth $14,842 versus $34,254 for the index. The asset allocations were mostly the same too. The top 10 holdings are roughly the same as the other funds, though they're weighted differently. Now let's look at the TOPS Growth ETF portfolio. We start out similarly with a $22 expenses for Class 1. Then there's almost the exact same description about equity performance and positioning for this one. This fund would have $20,649 versus the $34,254 for the index. Returns were 11.09% in 2024, 7.65% over 5 years, and 7.52% over 10 years, but underperforming S&P in all 3 periods. Looking at the holdings, there is the same focus as in previous funds, but the equity exposure is at 84.8%, by far the largest holding of any of their assets. We arrive at the last report for one of the funds in this group. It starts out with the same description as usual. The raw numbers from 2014 say $18,555 versus $34,254 for the index, so underperformance is expected at this point. The advisory costs seem to be the only difference, with slight variations between Class 1 and Class 2. Let's summarize. Across the board, the report shows a common theme. These funds underperform the market, specifically the S&P 500. Most of them point to similar reasoning, which usually involves emphasizing growth stocks, small and mid-cap equities, or international versus the benchmark. You will have to ask yourself whether you believe the value of holding these funds is worth the cost. The report says the company's internal controls are effective and that there were no significant changes to these controls. So at least we know that the company says there isn't an internal issue impacting these numbers. Overall, there's a commitment to ethical standards, with the fund adopting a code of ethics applicable to key personnel. There were no reported amendments or waivers to this code during the reporting period, which suggests a stable ethical framework. Now let's step back and consider what all this means. The direction here seems to be towards broad market exposure through ETFs, but with some active management attempting to add value. However, the consistent underperformance, despite their explanations, is definitely a weakness. Their fees for some classes are low compared to the category, which is good, but not enough to justify the poorer returns. While there are no immediate red flags, I'd say investors should carefully weigh the benefits of this approach versus simply investing in a low-cost S&P 500 index fund. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more insights into the world of corporate finance.